Welcome to today's edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com. Of course, our special guest today is the one, the only Danielle DiMartino-Booth, a longtime friend of mine, and always love having her here. She's always a great insight, former insider of the Fed. She is now the CEO of Quill Intelligence and the writer of the Daily Feather. You can also find her articles on Bloomberg, and of course, she shows up just about everywhere in the media, so it's always easy to find Danielle. Danielle, welcome to the show today. How are you?
I'm great today, Lance. How are you?
It's been an interesting week, and really more so an interesting weekend. For the last couple of weeks, I've been writing a lot, talking about the impact of trade and tariffs and the impact on the economy. And in June of 2018, right after we had launched into this whole trade war issue with China, I wrote an article saying, well, this is going to impact earnings. And we'll see earnings decline by about 11% as we get into 2019. It's going to wipe out the entire benefit of the tax cuts. Well, that's exactly what happened on a 10% tariff. And now, over the weekend, we're now talking about both U.S. tariffs and retaliatory tariffs as much as 25%, 150% increase in tariffs. I just kind of wanted to get your initial, before we get into the Fed, which I know is your bailiwick, because this will lead us to the Fed, is I kind of want to get your initial thoughts about, this trade war, the tariff issue. Donald Trump says, this is great for America. What do you think?
Well, look, I think right now, if you look and see how much of a favorable outcome to the trade talks was baked into the market's trading, and you see how much can come out in a very quick period of time, you have to appreciate that this market is priced to perfection, and that it's not a matter of quibbling about whether this is going to shave. I mean, this is the buzzword used after the increase in the tariffs. Is this going to shave a 1/4 percentage point or a 1/2 percentage point off of GDP? For me, it's all theatrics, because if the confidence game is to collapse, then you're not talking about fractions of a percentage point. What we know, Lance, is one thing and only one thing. We might not have a broader ownership of the U.S. stock market than we ever have, but that really is irrelevant. That's a red herring. What we have is an economy that keys off of the stock market more than it ever has. It is more sensitive to stock market moves than it's ever been. The downturn in the stock market was able to have the majority of the CFOs in the United States towards the end of last year saying that we would be in recession in 2019. The rebound in the stock market in the first quarter was enough to have those CFOs say, you know what, we do still see recession coming, but it's going to be a 2020 event. We're going to push it out into the future. So what this trade war, to me at least, does is, by shattering this facade of confidence, investor confidence in the stock market, and pulling it down, it's going to bleed into the real economy. This is not a matter of trying to very carefully determine which industry in particular is going to be affected and how much that could end up, again, shaving off of GDP. Yeah. It's a much bigger game than that.
Absolutely. And I think that's absolutely right. And when you start talking about the economy is also, when you take a look at the economy and potential recession, ultimately down the road, whether it's a 2019 event or a 2020 event, whatever occurs, one of the issues that even the Federal Reserve has, noted more as of late, and I think it's interesting, when the Federal Reserve talks, people kind of pick out what they want to hear. And what they've been picking out is saying, oh, well, look, they're not going to raise rates. That means, we can just own stocks because there's going to be no more rate hikes, and this is great for liquidity. And, thank goodness the rate hikes are over. And, oh, look over here, they're going to stop, reducing their balance sheet because, well, that just means more liquidity sloshing around the markets. But in reality, if you look past what the headlines were and listen to what the Fed was saying, they've been saying some very interesting things, like corporate debt and leveraged loans are something that's concerning them. Now, the Fed can't come out and just say, oh, this is really bad and it's going to be really bad for the markets, because they do move the markets. But they've been dropping these little hints and warnings about concerns they have. And when you talk about not hiking, not lifting rates anymore, not reducing your balance sheet, that tells me that the Fed is a lot more concerned about economic growth than maybe what headlines are saying and potentially the rest of the markets. What do you say?
Well, again, I think that you're talking about one Jerome Powell, who understands better than anybody who's been in that office, possibly even better than Volcker himself,
right,
what the transmission mechanism is between the credit markets and the real economy. And what he saw in late 2018 with the freezing up of the credit markets, with the high yield issuance market being shut down for 41 record consecutive days, what he saw was that if this was going to feed through to the behavior of corporations, such that not only was the Fed in a pause mode, but if there are disruptions in the credit markets, then CFOs are going to stop buying back their shares.
Right.
That's a game over situation. It really is. When you see headlines that say, for example, AT&T's executives are going to pay more attention to their balance sheet, that is not shareholder friendly. And I can't emphasize enough that it is only and all about the liquidity. The Chinese authorities stuffed almost $900 billion into the global financial system in the first quarter of this year, in addition to the Powell pivot, which pushed hundreds of billions of dollars of share buybacks into the U.S. stock market. The broader picture here is if you had not seen stocks rise with more than $1 trillion of stimulus flowing into them, how indicative is that of how sensitive the markets are? And I think that that's why when the Fed publishes the financial stability report and it flags corporate debt and leverage lending, which it knows is off the rails, it really can't use that technological of a term. But it knows that covenant light is over 80% of the market. It
right.
knows that the leverage is not in the conventional banking system, that it has moved into the shadows, that private equity pretty much runs the financial system. It knows all of these things, but it can't acknowledge it. But it can raise up small little yellow flags that for investors should be great big red ones.
Right. And this is, I think that's a great point, Danielle, because, when you start talking about leveraged loans, and I actually wrote an article about this last week, talking about the issue of debt. And, when we go back to the financial crisis, right, everybody goes, well, we'll never have another financial crisis again because, that was subprime loans and mortgages, and that was a huge amount of debt in the economy. And we're just talking about leveraged loans over here, and that's just one little thing. Well, the problem is it was only $600 billion in subprime mortgages that basically locked up the markets. We're talking about twice that amount in leveraged loans, $1.5 trillion in leveraged loans and covenant-like loans that have been rolled off into CLOs. We didn't really learn the risk of the game in 2008 because everybody got bailed out, and now they're back playing the same again under the assumption they're going to get bailed out again. We'll see. But, this has to be a point to where investors have to start paying attention to the risks they're taking on in their portfolios.
Well, they absolutely do. And I think the difference between then and now is that back then, the entire European economy keyed off of bank loans and to almost exclusively bank loans. They also have a leveraged loan in a CLO market. We have a black box of debt in China. So it's not just an isolated issue of $600 billion of subprime mortgages that could potentially bleed into the global financial system. It is that the risks have built up not just here in the United States and to twice the magnitude, but it's that they've also spread such that we don't know what the interactivity between these markets is going to be once the system is truly tested.
And we're talking with Danielle DiMartino-Booth. She is the CEO of Quill Intelligence and the author of The Daily Feather, also a Bloomberg writer as well. Catch all of her articles at Bloomberg as they come out. Simply, we'll be right back after the break with more of the Lance Roberts Show podcast right here at realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.